was yesterday, stock market goes up. Why does stock market go up? Because they say they were happy that Jerome Powell said the Fed would never increase the interest rate by more than 0.5%. So they were like, yeah, and then it went up. And then today was crazy. The market was just like crashing in a way. It was like, they're like, it's a bloodbath. And I was like, why? And they're like, oh, because they misinterpreted what he said. And then I was like, wait. First of all, how does that happen? How are markets changing because somebody didn't read something or understands, and all of you at the same time? And then secondly, why do markets do that? Does that make sense?
There are three aspects of stock markets to unpack here. Firstly, interest rates and stock markets have one of the oldest financial relationships. The Fed, raising the federal funds rate will usually cause stock market prices to fall. This could be for a couple of reasons. When central banks raise interest rates, loans for companies and consumers become more expensive. Companies face higher debt servicing costs, which eats into profits. Lower expected profits equals lower stock valuations. Safer alternatives may also become more attractive. When rates rise, bonds, treasury bills, and savings accounts suddenly look more attractive, with higher yields and lower risk. Investors rotate money out of stocks and into bonds, causing stock prices to fall. So why are stocks rising when the Fed raised rates by 0.5%? The second aspect here is that stock prices move based on expectations of the future. If people expect prices to increase, they will purchase that stock based on this expectation. If more people had the same analysis, all of them would start buying the stock, pushing the price up till the stock meets its expected value. In this case, the general expectation was for a much higher rate hike. So when Powell announces a hike of 0.5%, this was better than market expectations, causing the market to rally. This would be the same for company earnings. A company's stock would not rise due to an announcement of strong quarterly earnings. If the market expectation was already for strong earnings, this would already be priced into the stock price. Prices would rise or fall based on whether they beat or fall short of market expectations. The third aspect is based on how market valuations are calculated. A company's value is calculated based on the last traded price multiplied by the number of outstanding shares. This has an amplifying effect since the last traded price is assumed to be the value of each share of the company. So even if one share of a company is sold for a lower price, it would reduce the market valuation of the company as a whole. This gives an inaccurate picture of actual market sentiment because it does not factor in trading volume. If 1% of shareholders sell their stock, the market value falls even though 99% of shareholders who are holding onto the stock clearly don't share that view.